Hey folks, it's Dave Burrows. It's 4 o'clock on Tuesday. It's time for a Barometer Readings webcast. I am in New York on location at a macro conference for the next couple of days. It's going to be a very interesting set of speakers we're going to hear and participate in a bunch of interesting sort of breakouts. My guess is there will be lots of noise. And then we'll see where things settle afterwards. We really don't think that there's going to be a lot that is settled tomorrow. I think that ultimately we're going to see a lot of headlines. We understand that tariffs are set to take effect right away, but my guess is there will be a lot of deck chairs get shuffled around in the next few days before we see where things land. So let's get a take from what the market's got to say. Obviously, markets don't like uncertainty. It's been a sloppy few weeks. And some of the things that are having difficulty in the market have been having difficulty for 6 or 7 months. It is really a split market. So just to start from the top, as we always do, you've got an S&P, which has been marching its way higher really since it made a new high in January of 2024. You can see the month of March, which is the most recent bar, was a difficult month. It was down about 6% for the S&P. And today, the S&P is about flat leading into tomorrow. When we look at a more near-term picture, you can see why we've been a little bit more cautious. After making a series of higher highs and higher lows, the S&P came down and broke the previous low from very early in January, traded down through the 200-day moving average, and then last week bounced back up into the 200-day moving average, testing it from underneath, and moved lower, taking out the lows yesterday before bouncing into this point where we broke down from. So technically, in the short term, the S&P is kind of broken. It's not a surprise. There's tremendous uncertainty in trade policy, and economic uncertainty is significant. Not quite what we saw in the COVID crisis, but it's not insignificant when you go all the way back to 2010. We haven't seen this level of uncertainty in a long time. It is interesting that flows have been mixed. Private investors, frankly, have continued to buy this dip, and there has been very little by the way of really tough sentiment. Put call data has not been skewed toward puts, which is what you would expect if you thought the market was making an important low. Generally, you see a big spike in put buying, people making a bet that the market might go lower, and that is not the case. We haven't seen the kind of big VIX reading that would show that there's really big concern about a major decline, and that's sort of counterintuitive. Generally, we like to see one of those emotional days before these things are over. Now, tariffs are not insignificant. As per Strategas, who are involved in putting on this conference tomorrow, they talk about the fact that this tariff proposal would be the largest tax increase as a percent of GDP going back over the last 40 years. So it's not insignificant, and it will have an impact on the economy, certainly have an impact on the consumer. When we look at the QQQ, the NASDAQ, heavily tech-weighted, 50% in the big cap tech stocks, again, came down through the 200-day moving average, tried to rally up underneath it, and then failed, breaking down below the lows from last week. And this little bounce yesterday and up to about 3 o'clock today, again, just underneath this resistance. So my guess is it's possible that we could see lower levels. And as you know, this is an area of the market that we have been avoiding because it has been relatively underperforming since June of 2024. So this has been underperforming for 9 months. And you can see this relative strength line relative to the S&P 500. It has been weakening, and the NASDAQ itself is trading only better than 42% of stocks in the S&P over the last 52 weeks. So this is not something that's new. It's not something that is tied to tariffs, but certainly it's not helping. We look around the world, global markets pulled back a little bit over the course of the week. Japan pulled back some. Actually, India, interestingly enough, had a strong month in the month of March after 4 months of correction. You can see here a relative strength. Relative strength became overbought in the late part of 2024 and probably needed some correction. And we did get 4 months of correction. Month of March was quite strong, and we started out positive today. Europe is only just beginning a bull market, only having broken out of the range it's been in, going all the way back to 2008. And sure, pulled back a little bit over the course of the week in sympathy with US markets, but technically is in a solid uptrend. Countries like Germany, Spain, France, the European market is off to a very strong start for the year. Some Latin American countries also performing pretty well. Argentina was down a little bit last month, started the month positive, and we again, we're in very solid uptrends in these markets, trading above all the long-term moving averages. So global stocks continue to outperform. And we put this up about a week ago. US is at the bottom of the list. A lot of markets, a lot better. To put it into perspective, this is the most significant S&P 500 performance versus the rest of the world going back to 1985. So that's a long way. And generally, you get these big shifts. They don't happen for a month at a time. They happen for longer. So we'll see. Now, we know that we have been seeing flows into Europe, into the UK, into emerging markets, into cash, which would make sense, some defensive securities. And we are seeing some money come out of the US, equities as a whole, technology in particular. And a lot of that has to do with the fact that tech has been so weak, and it's a big part of the US market. China, after a first 2 strong months, has been trading sideways over the last 5-6 weeks, notably no weakness in the lead up to these tariffs, surprisingly. Some stocks doing very well, some stocks doing poorly, but in general, the consumer sector is doing pretty well. And when we look at around the world, all of the various ETFs, you can see year to date, lots of green on the screen. Of course, the US is not. So this is a shift that's taking place. The TSX, frankly, has been remarkably strong on a relative basis versus the US, outperforming. And you can see down a little bit in the month of March, started the month positive. And as we've talked about over the last many months, slowly the TSX is outperforming the equally weighted S&P. So that's a change. And it's a change that the all-world ex-US index is outperforming the S&P. And my guess is that with interruptions, that can go on for quite some time. US dollar has been helping that situation. The US dollar has been backing off for many months after a very sharp move down in the month of January. We've seen a little bit of, February, a little bit of consolidation over the last 4 weeks. But if that's the bounce, it's not a very powerful bounce. The next test will be this rising 200-day moving average. When we get to fixed income, we've talked a lot about this over the last couple of years. We're in a rising rate environment. I thought this week I'd put the 30-year yields up. So this is the yield on a 30-year Treasury bond. And you know, it's looking like it's headed higher longer term. So this is the low from 2020. We've seen a series of higher lows and higher highs. Look at this consolidation that's taken place over the last 18 months. And a few weeks ago, we came out of that consolidation, then we're retesting it from the top. So I can understand why the Trump administration is concerned about the cost of refinancing the debt. I can understand why they want the market to believe that they can cut spending. You know, ultimately, they need to roll over about a third of the US debt in the next 12 months, and they would like to do it at lower yields. Surprisingly, yields really haven't come down all that much given what they've talked about in cuts. The long end of the US Treasury bond is not performing well and still is below all of the long-term moving averages. And to me, we look as though we are still in a bond bear market. Now, that That's the long end of the bond market. It may well be that rates coming down help the short end of the bond market, the 2 and 3 year bonds. And if the economy starts to slow down, you could see those do a little bit better. So for the bond money that we've been focused on short-term bonds. When we look at those relationships we've looked at for the last couple of years, S&P versus long-term treasuries, still in an uptrend, but we are testing, with the S&P weaker over the last month, we are sort of at a key level. We'll see where that goes. At this point, we'll give the benefit of the doubt to equities versus bonds, and dividend growth will give the benefit versus bonds. But again, both of these are testing important levels. We'll see whether we can quickly get back above this 50-day moving average or not on a relative basis. So less clear that it is dividend growth versus bonds. It may well be we're seeing a growth scare based on what is essentially a tax increase if you put in tariffs. What will that do to the consumer? Will they pull back on their spending? We've had anecdotal evidence, and certainly the consumer discretionary sector is behaving poorly. When we move over to the other big asset class, commodities, this is, just a really interesting story. Commodity prices have been rising steadily since inflation kicked off in 2020. They went sideways through the period of global tightening, where central banks were supposedly going to choke off inflation. But look at these monthly moves over the last many months. Commodity prices are clearly moving higher, and there is no stop in sight. Gold prices are moving higher. Silver prices are moving higher. We've talked about the fact that, silver, like gold, when it gets into a bull market, you can have a very explosive move, and we're in the very early stages. Copper prices have been moving higher over the last few months and coming out of this range that they've been in going back to 2011. This is an important change. So these things point to continued inflation. Now, the Fed has said, well, maybe it is a one-time thing, these tariffs coming in, and it will be a one-time step up in prices. Of course, the Trump administration is hoping that that will fuel companies to build capacity in the US and that they'll be able to compete against products coming in with large tariffs. But when we look at commodity prices, it's a free market. Commodity prices are moving higher, signaling that likely inflation is going to be more sticky. Commodities versus bonds tell that story, an inflation asset versus a disinflation asset. Bonds do well in disinflation, commodities do well in inflation. Commodities are clearly carrying the day. And commodities relative to the equally weighted S&P over the last 6 months have also really started to perform. So this is why we have significant gold weight in the portfolio. It's not because we're gold bugs. It's because the market is telling us something's changing, and we have to hedge the portfolios against those risks. And gold is a hedge against inflation, as some of the sectoral exposures we have as well. We looked at this last week, gold versus utilities. Again, inflation versus disinflation. Many people would think when you get into a difficult environment that bonds and utilities are the defensive asset. And I would say that they are not playing the same defensive role that they've played historically. Just on the topic of Bitcoin, because I get asked, Bitcoin has pulled back recently, but frankly, versus the equally weighted S&P, it continues to be in an uptrend. We'll see whether that continues. It's been caught up in the sell-off in technology shares. It turns out a lot of the same people who own Bitcoin own technology. And so if you've lost some confidence or you're getting a margin call, the same owner owns Bitcoin and tech, they may be selling Bitcoin to cover their margin calls in technology. But on a relative basis, actually hanging in pretty well. Canadian dollar. One more thing to touch on from a big picture perspective. We've talked about the fact that when the tariffs got announced, we had a spike down in the Canadian dollar. And frankly, since then, it's been working its way a little higher. We're going to get the news tomorrow. We'll see just how resilient it is. But we did get down to the same crisis levels that we saw in March of 2020 and at the worst point of the commodity sell-off going back in 2016. So look, we don't have to be everywhere. And we spend this webcast every week doing a little bit of navel gazing to say, where is the leadership? And are our portfolios focused in the right area? We've got to be open-minded and look for change, new leadership to emerge, or old leadership to recede, like we've seen in technology over the last several months. And sometimes there is no leadership, which means it's okay to sit on our hands. So our goal is to be tactical, to build portfolios that address the current situation. Sometimes it means we have a significant cash weight like we do right now. When there's a lot of uncertainty and there's not a lot of clarity, we're not going to pile into 2 or 3 sectors that happen to be doing well. Doesn't make sense. We need to have flexibility to be ready to make change in the portfolios when new leadership emerges or when the market starts to heal. Very clearly, we like to be in parts of the market that are seeing expanding breadth, where more and more stocks are participating over time. It means it's a healthy part of the market or market itself. It means money's getting put to work. And over time, when you're in an expanding breadth environment, the rising tide lifts the boats. So we use our work to try and address the key factors that drive return. Yeah, we're trying to find good companies, but we're also trying to start with parts of the market that are seeing net inflows. Where's the money getting put to work? Let's focus in those areas. What is it that people have an appetite for now? And then do our bottom-up work to try and find specific securities that we can use to express our view. And where we can find securities that meet our business tests, that are technically sound, and they match up in parts of the market we care about, that's where our portfolio lives. And it's just a process that we follow every day. The fundamental team is constantly screening ideas, trying to find securities with an accelerating line of revenue and earnings growth and improving balance sheets, and that are technically sound. And so right now, in a market where breadth has been deteriorating, we're building our farm team. We may not be adding new positions, but our job is to find new ideas that if the market were to make a turn, these are companies that have been stress tested and held up well against a tough tape. When breadth is weakening, it may not be all the securities sell off at the beginning, the weak ones sell off at the beginning. And if the sell-off goes on long enough, it impacts a broader and broader list of securities. So I think folks know we use stop losses on our positions. When breadth starts to deteriorate, we get more defensive. We raise some cash, we tighten up our stop losses, and we stop putting on new positions. So we're in that period where we got to sit on our hands. And, we have people calling to say, isn't there something we can do to put this money to work? And you don't want to look at 1 or 2 good days and say, well, it must be getting better. We need some process, and we need to see improvement in the underlying breadth data, and we're not getting it yet. Bullish percent for all US stocks. If we take the NASDAQ, the NYSE, all of the optionable stocks, and track the percent of stocks in uptrends, it's just over 30%. So 70% of stocks are making lower lows and lower highs. That is not constructive. And the percent of stocks in uptrends has been weakening. One by one, stocks have been getting hit. So it's our job to make sure we're using stop losses on our existing positions. Frankly, the positions that we're in are hanging in remarkably well. Now, inside the market, it's a split market. The NYSE is marginally positive. The NASDAQ has been seeing solid deterioration. But if we take all US stocks, we have seen weakness in breadth. If we take all NYSE stocks, percent of stocks trading above their 50-day moving average has been falling. That's a measure of short-term trend. And it's the same for Canada, same for globally. Certain markets globally, some European markets and Asian markets, actually look pretty good from a breadth perspective, which means that we can put some money to work there. And we've been looking at American depository receipts that trade in the NYSE that give us access to some of those global companies, or we've been using our global fund. The percent of stocks with positive weekly momentum has also been weakening. This is incorrect. This should be red. And the percent of stocks trading above the 150-day moving average also should be red. 3 of the 4 short-term indicators are red. I'm going to have to talk to my fellow who updates this today. But the net of it is, we're not in a point in time where we have to push on a string. When we look at year-to-date flows, there are some flows going into gold. And there are some flows going into European equities. And understandably, market sloppy, there are some flows going into bonds, even though price is not moving very far, because there's a lot of bond issuance being done. When we look at the bottom end, money's come out of small cap stocks, some money's come out of golds. It's interesting, this is year to date, money's come out of energy and money's come out of healthcare. If we look at just the last month, it's a change actually. Money's going into energy, it's going into financials, it's going into materials. Well, these are groups that we spend a lot of time talking about and frankly have held in remarkably well through the course of this correction. At the other end of the spectrum, both for the week and for the year, money is coming out of tech. If we look at for the week, some money came out of industrials last week, but about flat for the year. Money coming out of utilities, consumer services, and consumer staples and consumer discretionary. Let's look at the charts. When we look at this long-term financials chart, it's very clear financials are in an uptrend. They're above all of the long-term moving averages. The month of March did come down, although we bounced about half of that when the market rallied last week. It was very quick to rally, and the point figure charts held in remarkably well. If we look at the actual daily chart, again, relative strength is making new highs. It's exactly what we want to see. The whole financial sector is trading better than 85% of stocks in the S&P. And when the market came down and bounced and went lower, the financials held at a much higher higher low. So that's a sign of relative strength. Now, the insurance companies really have been carrying the day. They've been remarkable. We've talked about, the insurance sector now for a year or 18 months. Fairfax, the biggest position we have at the firm, made a new all-time high today and a new relative strength high. So a leading stock should very quickly go back to highs when the market has a small bounce. That's a sign of relative performance. It's a sign that all of the investors are happy and there's money looking to be put to work in this area. Intact Financial, another Canadian property and casualty company that was bought not that long ago in accounts, making a new all-time high today, up almost 1% and a new relative strength high. So insurance continues to act well. Frankly, broker-dealers or asset managers are also performing well. Relative strength continue to hold. They have come down in price, but they did hold well below the lows of the recent pullback, while the NASDAQ went on to make lower lows. So this is a group that we think has some room. The largest position in here is Goldman Sachs. European financials pulled back a little bit over the course of the week, but trading better than 92% of stocks in the S&P. So we've talked about the fact that Europe and China are all seeing financial services come up. And it makes sense. Financial services companies do well when short-term rates go lower and long-term rates go higher, and there's a spread that they can use to make a return. We're in the very early stages of a new bull market in European financials, and there's a lot of them. When we get to energy we've talked about as being a consolidating asset, meaning it was trading sideways while the market was weakening. Now it started to move higher over the last few days, and on a daily basis, picking up strong relative performance. And we are at a point in time seasonally where energy tends to outperform over the next 2 to 3 months. So the XLE, which is the broad-based energy ETF, broke to a higher high on the point and figure chart. That's a buy signal. And we've seen the number of stocks making 20-day lows at 0. So when the market sell off last week, 0 energy stocks made a 20-day low. That is relative performance. If we compare energy producers relative to the QQQ going back to 2014, This is an important shift taking place. This is like what we've seen in gold versus the semiconductor index. So energy looks like it's ready to have a move, and the leaders are. You know, over the last few weeks, we've talked about the gas producers, ARC Resources in Canada. Well, we just marched higher all through the last 2 weeks, making relative strength new highs. Expand Energy, the old Chesapeake, new absolute highs, new relative highs. And when we look at the longer term basis on Expand, it made a high in 2022, consolidated for the last 2.5 years, and is now breaking out. That's a new leg higher it's entering. So we think the gas stocks look pretty darn good. We also think the infrastructure companies look pretty good. AMLP is an ETF that owns pipeline companies in the US, making relative strength new highs. We've talked about TRAP. We've talked about, TC Energy. We've talked about Enbridge. These companies are performing really well on a relative basis and paying us great dividends and have nice dividend growth. Get to the golds. The golds continue to act well. Agnico, Alamos, Wheat and Precious Metals, Kinross. Well, it's for good reason. Prices are going higher and there's no new production. The whole group is marching higher. When we look at what's happening with Agnico, it's in the very early stages of what we think will be a much longer term bull market. These companies, the difference between their cost of production and what they're selling them for continues to expand, which means we're going to see expanded dividends, excellent dividend growth, and excellent cash flow. I thought this was an interesting statistic. I feel like we've been talking about gold stocks for a year now, and it wasn't very popular when we started, and it obviously still isn't popular with the public. In gold, these are the number of shares outstanding in the gold producers ETF. What it tells you is investors continue to sell them. They don't believe this rally, and I understand it. Gold shares didn't do well for a decade, and now they are, and they're saying, here's my opportunity to get my money back. Well, we're trading at new highs, and basically we're trading at multi-year lows in the number of dollars getting put to work in this group. So we think that's quite interesting. On the copper side, copper's showing some improvement, both in the smaller ones and the larger ones. The point and figure chart's quite positive, pulled back a little bit over the last couple of days. But we think, again, this is a move toward inflation-oriented assets. Let's talk a little bit about the industrials. So aerospace has been holding in better than almost anything in industrials over the last few months. Obviously, the defense spending is going up around the world, but anything aerospace related has been strong. In the most recent pullback, the point and figure chart for the sector has remained strong. And even the waste companies have been continuing to perform well also. So Waste Connections, GFL, Republic Waste in the US, all have been bucking the trend. No tariffs on waste. We talked about Howmet. Howmet continues to perform well. And on the other side, the transports are sloppy. So the thing we take away from this is obviously tariffs are going to put a crimp in some of the transportation companies. And the market is adjusting for that. So what you can see here is we have a market of haves and have-nots. Communications staying relatively strong. And in there you have Netflix and Meta. But this is the crux of the problem in the market. Frankly, there's a lot of stocks doing well, but there's some really big ones that are doing poorly. The XLK is down about 15%. That's the large cap technology ETF. Relative strength has been falling since June. We talked 2 weeks ago about the fact that they had broken the 200-day moving average for the first time in over 500 days. Global tech is doing the same thing. The Mag 7, the big names we all know, now trading below the 200-day, and after rallying last week up underneath it, made a new low yesterday and have been unable to recapture. So until this changes, this group is untouchable. If I look at my point and figure charts for the software sector, steadily lower lows and lower highs. If I look at the semiconductor group, again today, a relative strength new low. So where some of the groups we looked at came down and touched on the 200-day moving average, bounced and have held above, like financials, for instance. Semiconductors broke the 200-day moving average a month ago, didn't get close to the 200-day on the bounce, and are now trading basically at the lows. So again, it's a market of haves and have-nots. The point and figure chart's very clear. This is the point and figure chart for the Mag 7 ETF. This is the bull market that has been in place since the end of 2022. That's a significant change. The semiconductor sector can continue to come down, even though it's pulled back a lot. And even though we believe that AI is going to be important, things get ahead of themselves. I think that this chart says that this move down in the semiconductor companies is not temporary. The last time gold started to outperform the semiconductors was in 2001, and then it happened for a decade. Technology outperformed for a decade coming into 2024, and now gold started to outperform. So we'll see, but I think that this points to a more significant shift. Consumer discretionary, a large sector in the US market, also trading below the 200-day moving average. And growth stocks. This is the Russell 2000 Growth Index. Again, nothing to do with tariffs. It's been underperforming for months. The defensive sectors, they've had a little bit of a bounce, but frankly, they're in downtrends. That's the real estate sector, utility sector. There's a few names that are performing well. We do own some Hydro One, which is trading very close to the highs. And we do own some consumer staples, even though the consumer staples group is weak. Dollarama trading close to 52-week highs, and Loblaws today went out at a 52-week high. One of the things I think about this is that in these companies, when producers put their prices up, the grocers have a tendency to take more price. So my guess is if we're going to see tariffs on goods, these companies will take the opportunity to raise price and add to their margin. And I think that's what the market is telling you. So let's wrap it up. When we look at the sectors across the board, they have been moving to the left, fewer and fewer stocks holding up in price. There's a few sectors that stand out that are further to the right, gas utilities. So that's pipelines, and they're performing really well. We talked about that. Insurance companies, we talked about that. Precious metals, we talked about that. The banks on a relative basis have been stronger, and the regional banks. Oil and oil service have been improving. You can see them in large letter. That means breadth is positive. Some basic materials, steel, behaving a little bit better on the far left of the equation. Semiconductors, electronics, biotech. Leisure, that's consumer. Builders, that's consumer. So there's a lot of groups that to us right now are untouchable, which is why we have a significant amount of cash. Breadth for the average sector over the course of the week was down 5%. And when we look at relative performance from the beginning of the year, we've got two groups. Inflation-related sectors, gold, Chinese consumer, gold, silver, European equities, copper producers, insurance, global ex-US, materials, financials, all positive. On the negative side, S&P, NASDAQ a little worse, XLK, which is technology, bots, which is robots, Bitcoin, genomics, high growth technology companies, and semiconductors. So at the end of the day, our job is to make sure that we own the things that are performing well, that we come out of the groups that are not. If breadth for the overall market is weak, let's be cautious. So we continue to have our biggest weight in financials. Energy at 14% is 3 times the S&P weight. Materials, which is largely gold, but some copper, 14%. But then we have short-term, this is T-bills and short-term bonds, 13% of the average portfolio. 10% is industrials, corporate bonds, another 8%. So that means 21% by way of T-bills and corporate bonds. We've got cash, 5%. We've got a smaller communication services weight, certainly underweight, but there's only 2 names that we own in the group. And then we get down into the groups that aren't performing. Technology is 1%, consumer discretionary is 2%, healthcare is 2%, utilities 1.5%, staples at 1.3%, and real estate virtually at 0. So it's a split market. So far in the year, it's not been a completely easy year. But if you look at a blended portfolio made up of a 10% in our global equity fund, 10% in our macro portfolio, 10% in our balance pool, 40% in our income pool, and 30% in the equity pool, we're down a little less than 1%. We got lots of options, right? Things will come around at some point. If we look at the seasonality, you would expect things to start getting better in April and May, but we've got a lot of uncertainty. If I look at the corporate bond market, it's pricing in a little bit more risk for corporate bonds, both high yield and investment grade. Not a lot, not like we saw in 2020, not like we saw in the sell-off in 2022 and 23, but we're watching it. When we watch volatility, it's sort of within the range. It's not showing some big spike. And frankly, we're a long way above the rising 200-week moving average. Markets don't go straight higher. From a seasonal perspective, we talked about February and March being questionable in the first year of a presidential cycle. April, since 1950, is the strongest month of the year. We'll see. In the presidential cycle, it also tends to be the strongest month of the year. And May is also another strong month. So we'll see after this news comes out whether the market can assimilate the news, digest it, and we see some money get put to work. Things get tougher, we'll get more defensive. Look, the third year of a cycle can have some choppiness. We had 2 great years in a row. Right now, we're sitting on our hands. We got lots of flexibility. We've got cash in portfolios. We got T-bills. We got short-term bonds. We've got a lot of financials that are performing really well. We've got a very significant precious metals weight that just keeps marching its way higher. Our global positioning is helping because it's relatively new over the last year, and global markets are in their first year of a bull market. We haven't seen one in over 10 years. So let's take in the information tomorrow. If I get something that is significant out of our conference here in New York, or if something is really noteworthy, we'll put out a short video at the end of the week. If you got questions that I haven't answered, certainly send us a message. But now let's see if we got any questions from the crowd. Okay, Lawrence is asking, if you only had 3% in gold and precious metals, would you add now? So my answer on that is yes. Does it mean that it can't pull back? They can't pull back by 10%? They could at any time. But when we look at what's happened so far in this rally, what looks like a big rally is very small relative to history. So I would stay with cash flow producing assets. You could buy PHYS, which is the ETF that is physical gold, or you could own a producer like Agnico or Kinross or Alamos or Wheaton Precious. Just one of the more conservative ways to be invested is with something like Wheaton Precious Metals or Triple Flag or Franco-Nevada. They get royalties from gold producers for having financed them. We do own some of those. But I do think that 3% is too little, and I would certainly add to them. Robert is asking, what are our thoughts on India and Japan? I think that the longer-term picture for Japan is quite positive. I think we're in good company. Warren Buffett is a big buyer. He's talked about issuing another Japanese-based bond and buying more Japanese equities. India has corrected sharply over 4 months. and seems to have found its footing. Again, I think it's in the earlier stage of a bull market. India's way outperformed China over time, and they have a consumer class that's coming up that is likely to drive growth for some time. An anonymous question, what is it going to take for interest in the precious metals equities to improve? That's a great question. You know, the leading companies, the intermediate companies that have been growing their production are performing really, really well. If you look at the index, it's masked by the Newmont and Barrick, the largest of the large caps, are really underperforming because they're not good operators and they have no new production coming on. So I really would encourage people to look at the intermediate producers, not exploration companies, producers. And they are performing well. There's a bunch of them that look attractive. And certainly I'm happy to have an offline conversation on that. And Bill is asking, why is Tech B underperforming? I'm assuming based on the spelling. Tech Resources. I think one of the things we're going to find out tomorrow is what are the tariffs going to be on copper? And there have been promises that there would be tariffs on copper. Tech B ultimately can find other buyers than the US for their copper, but there are concerns around the tariffs. Most of the copper producers, the large cap ones, have had a harder time. Some of the US-based small cap copper producers or developers are performing better because there's encouragement to get those developments done more quickly, and there'll be friendly policies toward them. But that's my guess if you're asking Bill about Tech B. Ultimately, it's a great asset. They generate a ton of cash, and over the course of the cycle, it's going to be a great performer. Okay, I think I got all the questions. I really appreciate everybody tuning in. Looking forward to this conference today and tomorrow. If I've got some interesting takeaways, I'll put them up on Twitter, and we may release a short video late in the week just to give an update on markets reaction coming out of tariffs. Okay, everybody have a great sleep tonight. It'll be a big day tomorrow. Markets are generally more resilient than you think. And certainly we've seen that there are some parts of the market that are acting really, really well, and we're happy to be there. So we'll update later on. Thanks so much for tuning in. Bye, folks.